Hey, Digital Wildcatters, welcome to Big Digital Energy. Chuck Yates here. I am back, just reintroducing myself in case people forgot me. Partners in crime, Kirk Coburn. You still in Nantucket?
I'm still in Nantucket. They're trying to kick me off, but still here.
Nice. And Mark Meyer. Mark, how are you?
Doing well.
So what are we going to talk about today? What did I miss since I've been in Europe 4 out of the last 5 weeks? How do you like that drop?
Well, the world is on fire, Chuck, at least in certain parts.
Rome was. I will tell you this. Rome was. All right, real quick before we start, Rome was, we did all the touristy things. We did the Colosseum, all that. The Sistine Chapel, we did the Vatican. You know what really kind of struck me, and I didn't think it would kind of get to me, but it did? Pope John Paul II's grave. Because all the popes are buried under St. Peter's Basilica. And it just kind of hit me because, I remember that guy and Reagan and Thatcher fighting communism, and the church has obviously had its problems. But anyway, that was kind of a moment
cool.
I didn't think that was going to get me, and it got me.
I just want to know if Southwest Airlines is chasing you down since you're spending most of your miles in routes that they don't cover.
Yeah, exactly. I've never flown Lufthansa before this trip, but I flew Lufthansa. So I had my tour through Frankfurt.
I will say first class Lufthansa, it actually rivals the Middle Eastern airlines in terms of their champagne and caviar is pretty damn good.
I agree with you. It did. The Kelly, my baby.
And by the way, you didn't buy first class. They saw, oh shit, it's Chuck Yates, and they said, right this way, sir. Is that correct?
No. Daughter Kelly came to me and said, Daddy, can we fly first class? Here's why we need to do it, because she had an athletic injury or some sort, and Daddy fell for it. But it was great.
I flew real first class on KLM, Lufthansa, Singapore, Malaysia, et cetera, a long time ago. Singapore's still top of my list.
Yeah.
At least back in the day. I don't know how much it's changed. It's been a while since real first class has been available.
Yeah, it was stunning. No, the champagne was good, and you're right. I don't think I got caviar, but it was pretty good. So, all right. So I think
let's make it punchy.
Yeah, exactly. Let's make it punchy. I was lectured on that in Sardinia, but we'll leave that aside. So when I left, the rig count was down slightly, week over week. The trailing 4 weeks, it was down. Whatever. Did I miss anything?
No, it's last week. It was a continuation of the same. You had horizontals down 5. 4 of those were in the Permian. That's 30 over the last 4 weeks. Publics continue to lead the way down, sticking to their capital discipline guns. You had so far a fairly uneventful, and we're just getting into the meat of energy earnings. Although you had the majors last week, which were, generally kind of neutral to constructive to okay. It's hard to beat a 2022 comp, right? So the numbers were down on a year-over-year basis, but generally pretty well received. Underneath all that, you've had a growing story of tightening fundamentals against a backdrop of, somewhat solid to constructive inventory numbers. There's still a lot of noise around things like adjustment factors, but what we've seen here recently is the IEA came out last week and they adjusted May demand up a pretty substantial amount, almost 1 million barrels a day, 973,000 barrels a day. On top of that, the adjustment factor, the week-to-week adjustment factor, which is the fudge factor, rose to a record of 2.4 million barrels a day. Again, a lot of analysts saying we're still suspect about data quality, et cetera. Jack McClendon had a good reply to Javier Blas's tweet on the adjustment factor saying, how can they publish the data given the fudge factor is slightly less than Kuwait's production?
Well, when I used to go out and fundraise and talk to investors, they would always ask, where are we, kind of supply demand. And I go, man, I am great telling you what happened 9 months ago. I can do that. But, look, at any given moment, we just don't ever know.
Well, and, demand sides come more into focus because of the adjustments, the upward adjustments. Goldman was out either late yesterday or today with a revision to 2023 demand. All that translates into a supply-demand deficit of 1.8 million barrels a day for the second half of this year. That's 600,000 barrels a day in 2024. So, directionally, things are starting to show up. Remember, we've been talking about the show me aspect of the fundamentals. Clearly, the equities responded. The XOP was up 11% or is up 11% or and change this month. So
Kirk, I'm gonna put you on the spot. Do we get $80 oil to 110 in like 30 days when the market gets slapped? Are we going to keep slogging around? What happens?
Well, here's what I want to ask. I'm not going to redirect and go to Mark because I'm curious. One of the headlines that came out of the earnings is that the Exxon and Chevron combined are holding on to about $14 billion of additional profits. And they've signaled that they're going to shop for deals. So I always think it's a little funny when you don't necessarily meet expectations and it's sort of like, earnings announcements are like so-so. But you tell people that, hey, but in the future, we're about to spend a lot of cash and it's going to be really accretive. As an analyst, what does that say to you? And that's going to be my answer to Chuck.
Was that the redirect?
That was the redirect.
That's the redirect.
You're the only analyst here. What does that mean
when you're saying, hey, here's our earnings, but hey, we got a lot of cash and we're on the hunt.
Yeah,
we're looking for deals.
Yeah, it's dry powder. I think it addresses somewhat, and I think the interpretation of both what Exxon and Chevron message or signaled was that their enthusiasm for shale hasn't waned. So looking specifically in that direction, and so I think that's I think that continues to be a positive. Does that bolster the notion that we have degrading inventory quality, which is still in a bit of a tug of war of debate, whether that's actually the case? I think for Exxon in particular, that makes more sense than for Chevron, but they're each going to have a competitive response that's ultimately going to be very similar as it relates to shale, in my opinion. And so I think that sets up well for, accelerating deal activity.
What's getting
going into next year?
Well, what's getting me about the earnings season is we're still getting AOC talking about windfall profits and the like. I sent a snarky tweet back that said I'd have, if I was an oil cartel, I'd have higher gross net income margins than Exxon currently did. It's almost like this cartel is as effective as a representative who's never passed a major piece of legislation. But no, at the end of the day, we're still getting that as well, even though, like you said, this year wasn't last year.
Yeah, and it's not 2020 when they were hemorrhaging gobs of profits. And
yeah, it wasn't 2012 to 2022.
I think you made the point in part of the snark that it's a really effective cartel that let prices go to minus 37.
Yeah,
right.
That's right.
Yeah,
that's right.
And it's because
they have high taxes, they want to have some losses in there.
Other analysts,
no one ever.
You look at kind of the long horizon, the decade leading into the inflection that was coming out of COVID and then in the new extended capital discipline, the sector virtually returned zero over the long haul with a pretty good tailwind of prices. And that was the shale sweepstakes where you're thinking or projecting that somehow field level or half cycle drilling IRRs are going to ultimately manifest as robust full cycle returns on capital employed. And we saw from the numbers that just wasn't the case.
Yeah.
And so we continue to see an extension of capital discipline and building dry powder for things like what we know is going to be at some point an accelerating consolidation game if asset values and cash flow stay at this level.
So let's
go. What do you make of this massive EIA demand revision? there's some other things at play that I think are interesting.
Fire away.
That was a question.
I missed the question.
The EIA demand revision for May from 973,000 barrels a day to 20.8 million barrels a day.
Well, if you roll that into the weekly adjustment factor conversation, are there other things at play here? I think the question is, are there kind of political dynamics as it relates to the headline numbers and then the catch-ups? If I saw a graph last week that showed how the weekly adjustment factor has blown out. Really, it got really muted in terms of deviation in 07, 08, 09. It started creeping up, and as you got into West Texas shale, and then certainly since COVID and recently has blown out. My somewhat naive or apolitical vantage point is we've got a lot of great technology to measure things that we didn't have 5 and 10 years ago. In my mind, if it is a measuring barrels standpoint, then that adjustment or that error should go down, right? But it's not. Now, that probably has nothing to do with anything, but just intuitively, that's the way I think about it. We have a lot of real-time measurement capability, a lot of technology, a lot of digital and satellite and other types of data collection. I don't know how the process itself of reporting has even adopted any of that over time. It's not something I've delved into, but it would be interesting to start to drill down. I think if you see a continuation of this, highly volatile and expanding adjustment factor, we're going to have some real need to really drill down on what's going on with the EIA and its data collection.
And you're seeing the same thing in inventory numbers too. So I mean, data everywhere is having adjustment factors and the like. All right, so let's go around the horn real quick to kind of close out this segment. What are we going to see, Kirk? Are we going to see slap in the face, prices go through the moon? Are we going to see continued drudging along, or are we going to see maybe a soft landing? However you want to phrase it, what are we going to see?
I mean, I think we're going to see prices continue to rise. I think August is going to be an interesting month to watch as we're about to jump into it tomorrow. There's still sort of the macro factors happening. I don't know what OPEC's going to do. And you never know what's going to happen with Ukraine, but I'm expecting that demand is really strong, and so you're going to see prices tick up.
Mark,
I think this is a good early sign of fundamentals pulling through despite all the noise. I'm not much different than that. I think given where energy is, and this is mostly from an equity perspective, where it is from both a representation in the market in terms of profitability and the weighting, but also the relative valuation and absolute valuation compared to, its competitor sectors that have garnered most of the inflows. I do think the fundamental story gets to a point of, you really got to start sharpening your pencil about adding positions here. That's not investment advice. That's just the way I see it. Because the fundamentals, as we talked about, are showing up.
So here's the deal. What's going to happen? We're going to slog along kind of like we have been as we roll into winter, and it's going to be winter weather that's going to drive whatever happens. So we wind up with the second warmest winter since 1882, last year being the warmest, at least that Europe had. Then maybe maybe we kind of slog along some more. If we wind up having any sort of a cold snap, all hell breaks loose and energy prices are through the roof. The Houston, Texas is going to have the greatest Christmas ever if we see a cold snap.
Unless we freeze.
Yeah.
So caution on, kind of recency bias or what you're experiencing is the average. This data is about a week old, or at least the summer data from June 1st through, I think it was July 19th. Lower 48 weather has been 0.07 degrees Fahrenheit warmer than normal, 0.07.
Rome was hot.
Well,
I will say that.
I mean,
Greece is hot.
Greece was hot.
I
for a
usually
couple
don't
of
give
reasons.
these sort of forecasts because, this is my special behind the scenes look. But I think so many Americans went to Europe this summer, that Europe's going to freeze itself to burn off all the American extra hair and follicles that they left behind. So we're going to have a freeze this winter.
There we go. All right, perfect. All right, the German economic minister, how do we pronounce that? Habeck?
Good enough.
Habeck came out and
Good for
said
me.
that citizens should prepare for 5 tough years ahead. I read the article, but I didn't get to see exactly what he said. They only selectively quoted him. He's crazy, dude, right? What was he saying?
Well, he's the economic minister for the Greens, and basically saying that, well, their goals really have a 2030 peg on them. And he said the next 5 years are going to be really tough as we need to turn the corner. And that is the pushing the acceleration of transition to renewables. We saw it in March with the shutdown of the last nuclear facilities and what that meant for power prices in Germany's largest state immediately. And so what he's saying is that we're not wavering. We're not moving off of this path, but he's also being very direct and very blunt. Whether you like the message or not, they're not, at least his rhetoric is very straightforward and very clear. You're going to absorb some pain, whether you're an individual consumer or an industrial consumer.
I mean, Kirk, dare I say he's being intellectually honest? I mean, saying, hey, we're going to spend a lot of money. Energy prices are gonna go up. The grid's not going to be as reliable. I mean, I actually am. I don't agree with that message, but I'm actually okay if that was what the environmentalist movement would say, because I think that's reality.
I mean, really, all he's doing is saying what has already transpired over the previous 5 years. I mean, has he? I mean, he's just saying, hey, it's going to be more of the same as far as I'm concerned. When I read sort of his comments. Well, I don't think it's politically wise to say that, but that's exactly what Germany has been doing. They've been cutting, off their internal coal supplies. They've been moving to get energy from other sources. I mean, there's a whole lot. And then if you read of what they're trying to do about Europe's all these interconnects, they're trying to connect all these different interconnects between the different grids amongst Europe. There's one between the UK and Germany, but the projects have been delayed due to supply chain parts, et cetera. And so there's going to be what they're trying to do and what they want to do are trying to do and want to do are two different things, because what they want to do is going to take much longer than they anticipated.
Well, when you say they, that I think that brings up good
point.
A nice. Let's break that down into who they is, right? In my sense, and this is purely anecdotal, from being in and around a few German cities over the last few weeks, is that I did not pick up one data point in conversation where there wasn't a building sense of fatigue with this on the consumer level. And from a business standpoint, I heard some talk of, look, I'm thinking of relocating to Italy because they have such an age gap in their population. The tax policy and everything else is much more favorable, which is stunning given the industrial profile and the industrial might of the German economy within the European Union.
And this is a marked departure from, I spent 4 days in Berlin last summer, if you recall, and I came back telling you that those guys are just going to gut it up and pay it. They're okay with it. It's great. I didn't hear any bitching about anything. They're the austere people, et cetera. It sounds like maybe something's taken root over the last year.
Yeah, I mean,
so you're talking about Austin?
Talking about Germany.
Yep, I know.
Oh,
but,
gotcha.
But what you're saying is Berlin, the people in Berlin.
Oh, gotcha.
I mean, are they high wages? It's it's nice to be top, in the top 5%, right?
Well, and I was talking about the Uber driver who, asked him about gasoline prices, and you didn't hear a lot of bitching, but it sounded like Mark actually got to hear some bitching.
Well, this was admittedly my most significant conversation was admittedly in a college town, right? So you've got a service economy that pays that type of wage, and you start putting additional cost and tax pressure on that individual and what that implies for standard of living or ability to afford to continue the lifestyle that they have, which is by no means opulent. In fact, I would call it austere in most cases, right? Is it a tipping point? We'll see. But I think the messaging is interesting, just given what has transpired over the last couple of years with respect to inflation. We continue to see German data points of industrial, slowdown, shutdown, that they're pushing, I think, what would be to the rank and file consumer or voter would be an increasingly unpopular policy point of view.
Yeah.
So we'll see.
So what's going on in the United Kingdom with the Conservatives?
There's the leadership is rolling back, and in the UK, to their credit, in this commitment, if in terms of getting after it, many years ago when it was time to sign up for net zero targets and legislate or make law and policy around things like phasing out sales of new internal combustion engine vehicles, the British are starting to see within the Conservative Party, they're starting to see a little splintering as these rollbacks by some are viewed as too aggressive. In other words, don't take us this far off the path that we committed to. And so I think that wedge potentially starts to grow, and I have no insight or familiarity with the British election calendar, but just picked up a couple of pieces that talked about this growing division within the Conservatives. And we've been talking a lot about, there's been a groundswell of pushback, but the commitment to these next generation policies, if you want to call them that, the UK was out front, and now having more of a radical rollback, if you will, is something that's causing dissension within the party.
Mm.
I mean, I find that interesting because the Conservatives are wow, I can't even say anything today. They're really struggling in the polls. So I don't know if the splintering is because of this, Mark. That's what I'm curious about. But at the same time, there are concerns that the green push has resulted in a cost of living crisis. So it's really across the aisle. That's interesting because the prime minister has not delayed the 2030 ban on the sale of new petrol and diesel cars. I mean, they're still banning, non-EVs in 2030. That's around the corner. So do you think it's the Conservative Party fighting because they're not getting a whole lot of traction in the polls, or is it something else?
Well, I think it's moves designed to roll those things like that back. And the Tories are saying, look, some of them are saying we're not, you risk loss of support within the party.
Yeah. So I was over in London for about 5 days and didn't pick up much. Had some of the greatest Chinese food I've ever had in my life, by the way. Kia in London, highly recommended. It was amazing. Didn't pick up much, man on the street.
Why didn't you Instagram that, Chuck?
What'd you say?
Why didn't you Instagram that?
I was keeping the semi-low profile out on Instagram with the European vacation. I popped up one or two things, I think, but didn't pick up much in the way of man on the street kind of feel for energy, but did find it really fascinating that they have done some stuff on the demand side, particularly meters inside the house that are giving you real-time feedback on how much energy you're using and how much it's costing. And that has an impact because one of the the couples we were had dinner with were talking about that. They go look at the meter 4 and 5 times a day, and okay, maybe we're going to turn up the temperature a little bit in the house just because it's costing us an arm and a leg. And we haven't done any of that in the United States.
The local retailers, Octopus being probably the leader here on technology, but the retail electricity providers in the UK have done a really good job of communicating the environmental cost and individual cost of electricity. I think it's actually pretty interesting.
My one British indicator was the one night I spent at the Duke's Hotel, in that typically the heated towel rack will burn your hand, and it was turned off.
There we go. It was the martini as cold as normal though?
It was. There's no cutting corners on that martini.
So I didn't get to have
shaken,
one.
Not stirred, of course.
I didn't get to have one because Sunday night the Duke's bar was closed. The night we spent at Duke's, so I still have yet to.
Used to be able to walk in, but I made a point of texting ahead and making a reservation.
You have to now, supposedly.
So I was only there one night and needed to have that experience again. It's been a while.
Gotcha. So, all right, let's turn our focus back to the United States. Wind is dead now. Is that what I missed?
No, Kirk, you got out front of this on Twitter this weekend, but I think it was triggered by something having to do with Rhode Island.
Yeah. I mean, Rhode Island basically canceled the wind project offshore because of the price. Economically, it just doesn't make any sense. They cannot produce, with all the capital and operating costs, they can't produce energy to compete even close with currently what they have. So I tweeted that out, thought it was funny. And then it was you, Mark, that picked up on who sort of replied to that tweet. Orsted's PR guy himself was like, wait a minute, wind's great because of all the government incentives and tariffs, which is kind of funny because that's exactly what you shouldn't say, I would think, if you're the largest wind producer in the world. I wouldn't think that you're saying, hey, we're getting paid by the government, that's why it's great. I'm like, that's sort of an oxymoron as far as I'm concerned. But Mark, what do you think?
Well, this was the second tranche or phase of the quote unquote revolution project, right? This one was called Second Revolution.
Right.
And so the full filing of Rhode Island Energy is not, I don't think, yet available with the Public Utility Commission. The most interesting thing in there to me was one of the reasons for rejection was this general uncertainty about federal tax subsidies, which kind of flies in the face of all the momentum behind things like the Inflation Reduction Act. I don't, know how directly connected this is, but, and maybe that was, hate to use the term, I don't mean it this way, but maybe it was a bit of a cop-out, right? But it does show you with all of these pressuring factors that, you kind of risk things higher. And so if there's this boatload or this tidal wave of tax incentive coming for offshore wind, why is there now uncertainty that is part of the reason that you decided to reject the proposal?
Well, and the dirty little secret of renewables is in a world of 1.5% to 2% interest rates, you can get things built.
Right.
In a world of 6 to 8% interest rates, when the cost of your debt equals the underlying cost or the underlying returns that your project's going to generate, there's just not any room for the equity there. So I had Robert Smith on the podcast about 2 years ago, and that's what he said. He said, literally, if you wanted to short interest rates, go short all the renewable projects, because second the interest rates rise, boom, that's going to be the deal. Yeah.
And then when you see all the capex going way up because of the supply chain issues and just the cost to build and the timelines, your projects are getting a lot more expensive to put in directly, as well as it's going to take longer, and then your operating costs have gone way up because of the interest rates. It's and you put all that in your little formula, and it says there's no way we're going to make money on it. Projects get killed.
Yeah. All right. This is, I think, probably the biggest deal of all the things we're going to talk about today. Mark, you threw this article around about banks coming up and trying to deal with carbon footprint and liabilities accrued on the balance sheet and all. Explain what's going on there, because I think this is really a big, huge deal.
Well, global banks are trying to come up with an accounting standard for emissions and, reporting your bank's carbon footprint. The big issue, at least in this article, was, look, they've elected to ignore 2/3 and only account for 1/3 in this latest policy iteration. And the argument is, and this is for capital markets activities, not direct lending. The argument is at least from the environmental opposition, is it needs to be 100% because capital markets activity is directly responsible for financing these projects that emit, right? And so the bank.
So just to step back, if you're a bank and you're capital markets, you're providing equity to an oil and gas company. Today you're going to get, or the discussion has been, you're responsible for those carbon emissions,
right?
Because you're actually providing the capital for that company to be able to drill, et cetera, et cetera.
This is part of a larger issue, and I would highly recommend, again, I tweeted it out or retweeted it, the podcast that Arjun Murthy did with Representative Crenshaw last week or the week before, talked about the various
incredible stock trader, by the way, just letting you know,
the various I guess points of political focus in this whole debate, and who's actually a threat or a risk and who's actually just kind of noise and entertainment. And so if you think about, all the focus and debate around the World Economic Forum, what BlackRock and Larry Fink are doing, what the IEA is saying, what the UN's saying, that's all very entertaining part of the debate. Was Crenshaw's point. And another adage I had not heard from him, which is, look, Democrats want to win, Republicans want to be entertained. And so they create these bogeymen type of dynamics. And Arjun's point was, look, embedded in things like the Global Financial Alliance for Net Zero, there are real risks to damage and injury here from not having projects financed. As we know, banks have, in some cases, pulled back on their willingness to finance fossil fuel projects. Munich Re is out of the business, and talking about the reinsurance market. So there are really actionable things that these companies can do that this more nebulous or more rhetoric-driven political distraction is not kind of a material threat, if that makes sense.
Yeah, and here's what I think's going on. If you're a bank and you're doing your underwritings of bonds and stocks, if you could throw oil and gas under the bus, you totally would. Sure. I mean, there's just not a lot of underwriting going on. The problem is you cannot create a standard, and this is what I think they're struggling with, where all of a sudden Amazon does not have high emissions because they've got vans running everywhere. And I'm picking on Amazon because I always pick on them about this point. Ultimately, if you create these standards, a lot of base businesses are going to show up as big emitters because they're using the oil and gas. And then all of a sudden you're shutting down anyone you could possibly underwrite for equity and debt. I think that's probably what's going on. Some lawyers sitting there going, hey, if we do this, you can't do an underwriting for IBM or whoever the case may be.
Well, I think there's a couple issues in this, Chuck. I mean, I think that's so right on. First of all, the issue is, why are banks taking any responsibility for someone else's carbon emissions? But that's a question, but that's happening. But the banks and what this story was talking about is that this sort of group of banks that got together and that are part of this carbon accounting financial partnership for carbon accounting financials. They're saying that, wait a minute, they've thought through this issue of us taking 100% accountability over equity financing an oil and gas company. We're going to have to count those emissions, but they're recommending that they cut those emissions. Instead of counting 100%, they want to count only 33% because they don't want to be burdened with those emissions. So it's interesting how the banks are pushing. I mean, the global financial system's pushing a narrative about carbon tax, but not for us. That's what I think the story is really interesting, is that they're trying to manipulate their own carbon accounting numbers by saying we're only responsible for 33% versus 100% of the emissions that our customers are ultimately generating.
Yeah, and it when you lay it right next to the oil and gas or the majors Scope 3 demands, it's not consistent, at least, right? Who's responsible? I was going to ask you, who's responsible for those Amazon trucks emissions? Should Exxon count those in Scope 3, or should Amazon be responsible Scope 1 or Scope 2? Or should the consumer who is ultimately got the goods that are being delivered by that truck to their individual residences, is that where that carbon footprint accounting should ultimately take place?
Should the individual that does 3 deliveries in one day instead of bunching them to 1 a week? I mean, who ultimately is responsible? It's a good point. I think, we in the industry, the energy industry, have been dreading the possibility of having to report emissions. I do think if they hold to the rules kind of as proposed in a weird sort of way, it's going to be good for us, because it's going to cause hopefully a more reasonable, rational discussion along the lines of what you just said, Mark.
For the banks, it's it's an appeasement, I think, in that, look, we'll take a third of them, right? Why a third? Yeah. Why not 10%?
It's arbitrary,
right?
Yeah,
I could make an argument. Yeah. There's an argument it should be 0. The environmental opposition says it should be 100%. My other question is in all this, and it was somewhat addressed by the question about the Amazon truck and who's responsible, is how much double counting is there going to be? Right?
Yeah.
And shouldn't this be, I always go back to what Scott Tinker said, counting, which is we have one atmosphere, right? And so it's your metaphor is
peeing and non-peeing section of the pool. Yeah, there are none. It's one pool.
And I don't want to completely sidetrack this discussion, but I think it's an important point in, where the highest concentrations and the most acute issues are. We've talked about it a lot. China uses a multiple of the next largest coal emissions polluter globally, and they continue to permit at a pace last year of 2 coal-fired power generation plants a week. And the somewhat naive notion is that we can, and I made it on the energy draft however many months ago that was, 18 months ago, was that natural gas is a strategic weapon with which the U.S. can play kind of economic offense by doing right by emissions reduction, because of the case study we have in the lower 40 or in the U.S. replacing coal with natural gas. But a really good point that it hasn't been amplified enough is it's an intractable economic situation for countries like China and India and Vietnam and a lot of Pacific Rim countries, because they have such an endowment of coal that they're not going to move off of that without some type of policy or governmental intervention. I think I mentioned that as, it needs to be addressed at the government and political level, but I really didn't have, a deep acknowledgement of that being the case.
Well, and I think you can even give them a moral leg up if you say everything you just said per person. Right. I mean, why should we count, China versus the United States? Why shouldn't we look?
It's 4 times as large.
Yeah, per person, because you get into per person, And I think China and India can say with a straight face, hey, United States, you're still worse than we are. And so, I mean, that needs to be addressed as well.
Well, some people still care about the sovereignty of nations. So going to this sort of one world idea doesn't make everyone comfortable. But I do think, going back to the double counting situation about the Partnership for Carbon Accounting Financials, who cares about double counting? If I'm the one that's administering or collecting the fees, the taxes based on carbon tax, based on emissions, if I'm in the middle of it, I'll tax everybody, even if I'm quintuple taxing. So I think there's something interesting going on with the banks driving this initiative. They're saying, hey, we believe in this initiative, but we don't ourselves want to be held accountable for 100%. But we're sure hell bent on making sure someone is held accountable, because we want to collect the money and we want to contribute as being part of the system that actually governs this.
Yeah, and they want to get,
to me, is what I'm trying to figure out.
Holly brought an extra tinfoil hat up to Nantucket, and I love it. I'm right there with you.
Woo! One world order. Let's go.
There will always be something to unpack on this particular line of discussion.
Yes.
So,
all right, my soapbox. This weekend I was sitting there.
This is good, Chuck.
Colin sent me a text and just said, I really hate this shit. And he sent me a tweet. There's a guy named Peter McKenzie. I have no idea who the guy is. He looks like a Silicon Valley bro type. Looks like he's a consultant to Stripe, so seems a techie guy. I think he actually lists on Twitter that he lives in Tokyo. But he came out, and you should go find this tweet. It was a great tweet about, holy cow, I just found out about fracking. And he spelled it with a K, of course. And he talked about, it seemed like sorcery to me, but I read the tweet as full of amazement and wonder. He called us mad geniuses for being able to figure out certain things. He lasered in on how important it was, private ownership of minerals and supply chain duplication of services and competition on that front. And I kind of went, wow, this is really cool. We've got a Silicon Valley guy who's at least showing some intellectual curiosity, saying some nice things about oil and gas. And energy folks read that like he was trashing our industry and just went nuts on him. Oh, you don't spell it with a K. Oh, we're not Don Quixotes. Oh, sorcery. And it just bugged me. So I went on a rampage this weekend about it.
Well, from my vantage point, over the last almost decade, we're going to need more and more of that talent coming in. And it relates to things that Sean Maher was talking about last week. Things like smart grid management, data science and engineering and analytics are going to be a big part of the next step. And if we don't embrace, or enlarge the tent, if you will, and welcome kind of the next generation or a new generation of capability and talent, energy is going to continue to lag in terms of its attractiveness for people who are passionate about analysis and problem solving, if that makes sense. I always made the pitch to people, look, if that really floats your boat, there is no more challenging and complex industry in terms of problem solving, particularly in the subsurface realm, just to put a finer point on it. There's a lot of very sophisticated data technology, the integration and tool building around all that is going to make a huge difference going forward.
And I will say this, with the advancements in AI and what's going on there and the potential for all of that, Silicon Valley needs energy today like never before. I had Tim Kramer on my podcast last week, and we were talking about power and the long-term outlook. We are going to use way more power over the next 10 to 15 years than we're anticipating we're going to need because of this. And I got one stat for you. A Google search is 1 watt. An AI search of the same thing is 5x that. Yeah, it's 5 watts. to train the AI in natural language to do that one AI search is 100 to 1,000 times that 1 watt. So we're going to embed AI in everything under the planet. And I Google search, 100 times a day for various things. It's going to happen. We're going to need so much more power. I think Silicon Valley is going to figure out they need us supplying that power. We have entrees to make roads there. Let's not be dickheads to them, because if we could align energy with Silicon Valley, which is where it's heading right now, we could actually have some political clout and we could do a lot of great things. And I worry that us energy guys are so jaded, we're so beaten up that all we do, we can't even take a compliment when someone calls us a genius.
Well, Chuck, you know what I like about you is you have this unselfish concern for the welfare of others. And I think that's the underlying thing that we need to take away when we're speaking about energy, whatever we're doing. I think we do. It's fun to debate on Twitter. It's fun to have these discussions. As long as we have data, because I think the three of us, we're super pro energy transition, but we also hold people accountable for being emotional about an argument when they're over their skis because they're motivated they make money through a faster transition, et cetera. But underlying, I think you're right. We need to have unselfish concern for others, at least, I guess that's the definition of altruism.
Therapy, all the years of therapy I had, it's don't get mad, get curious. So if somebody says something, it's like, hey, what's that all about?
Boys, this has been fun.
It has been fun. I look
forward to seeing you guys in the studio next week.
We look forward to having you back as well. Digital Wildcatters, thank you for joining us this week. If you like the podcast, subscribe to it, share it with a friend. We'll be back. I think we'll have all 4 of us back next week. We'll drag Colin into the studio, and we look forward to seeing you then.